Checklist item number 66, make a growth plan and resource it properly. People who make plans to grow have a much greater chance of growing than people who don't make a growth plan. Startups are intended to grow. If they are not growing at a brisk, consistent, vibrant pace, they are dying. That's basically how the venture community and public markets eventually look at these things. You're either growing or you're dying. If you're going sideways, you're not growing, you're dying. Maybe you're in it to fight another day. Great, you're default alive. But we're really looking for growth. And when you're starting, you're telling a story about future growth. When you start actually ringing the register and have users signing up, now you're selling performance. So you have to know, hey, am I selling the promise of my company or the performance of my company? In the early days, you're generally selling the promise, but at some point you get to $1 million in revenue, and now they're going to be looking at the performance as well as the potential and promise of your business. And you can make in your plan a 5%, a 10%, a 20% month over month growth plan. And I suggest you do that. And then you should look at what compounding growth does to a company that's making $100,000 in year one versus, and then 5% compounded growth, 10% compounded growth, and 20% if you're making but $10K a month. These are radically different scenarios, right? Adding $500 a month versus $2,000 doesn't seem like a lot, but go ahead and do compounding and you'll see why compounding interest rates, and people will fight for 1 point or 50 basis points or 25 basis points on a mortgage. There's a reason. Compounding interest rates, compounded growth rates really do work. And you got to ask yourself when you make these plans, well, if I'm trying to grow 20%, where's that 20% growth going to come from? Okay, 25% of the 20% of growth is going to come from landing and expanding. Okay, that means we have to have great customer success, great customer support so that people will add people. And are we asking people if they want to add people? And do we have that set up? Okay, well, if we're going to resource that, we're resourcing one group of people. Oh, we want to get 75% from new customers this year. Okay, 75% from new customers means we need more salespeople. Okay, and the salespeople need more leads, and the salespeople turn over quicker than regular people in the company. So we're going to need, for every 2 salespeople we want to have online, we're going to need to hire 3 because 1 out of 3 are going to leave voluntarily or involuntarily. So make a plan and then benchmark yourself against the plan, and you will be delighted to see how well things go for you. And again, just like this checklist helps reduce anxiety and keeps people focused, so does a plan. Okay, startups should always use accrual-based accounting. And that's item number 67 here. Make sure you're using accrual-based accounting, not cash-based. Just like some people will start a venture-backed startup and make it an LLC and then have to change it to a C Corp. Some people start with cash-based accounting. They sell somebody a 2-year contract. They book $100,000 in November. Then they have somebody on a monthly contract in November. Instead of selling them $100,000 over, 2 years in advance, they're just taking $2,500 a month right now. And that's coming in on a cash basis. So you basically are confusing everybody as to what's going on. Have a great accountant or have a good accountant, but have an accountant and get to accrual-based accounting so that you're booking your revenue when you actually delivered the service. That's what it means. If somebody buys a year-long membership to a gym, the gym doesn't take all that money in January. They spread out, the $1,200, $100 a month, right? And you book $100 every month. And the same thing is true for expenses. You can then spread out expenses. If you had to buy, a forklift or a tractor at a farm and you're leasing it, well, you're paying every month that lease. But if you didn't lease it and you paid cash for it, well, you could say, well, the life of this, $120,000 tractor is going to be 24 months, and then we're going to sell it and get half our money back. Therefore, $60K over 24 months equals this amount of money. And we'll spread out those costs. And you can talk to your accountants about how to do that legitimately. And it gives you just a more crisp view of the business, and it builds your credibility, doesn't it? So often people ask me if you're using cash-based accounting, if that eliminates you from raising venture capital. No, but they might say, fix this and then we'll fund. So it might delay your fundraising. If you're kind of meandering and you're not high growth and you have cash-based accounting, those two things combined might lower your credibility so much that the VC just invests in somebody who's got tighter books and a tighter snapshot of the business. When you're doing cash-based accounting, really the problem becomes you don't understand the business. And we really want to understand the business. And if you can't understand the business in a crisp, clean way, can't explain it, and you got all those cash problems because you paid your legal bill that comes up every 9 months and you were behind a year, you paid $75,000 this month and we don't know what's happening with the business because it's so spiky. That's a big problem for investors. So I really think that that's the problem, is your credibility and the ability to tell your story and understand the reality of the business. 68 on our checklist. Are you default alive, and why is that so meaningful? Paul Graham wrote this in a 2015 essay. He wrote some great essays about startups. Really just the master of focusing on what's essential in a startup. And then that comes from investing in, he probably did the first 1,000 investments or so in Y Combinator. And default alive basically means you're at break even or even profitable, and you've got unlimited runway. You don't need to raise any more money. And it puts you in the driver's seat of a founder for many reasons. You only need to raise money if you want to, and if the terms are great. So in September of 2019, I coined the term the Pegasus startup in a blog post. And quote, I'm quoting myself, it's a little obnoxious. A Pegasus startup is one that is so profitable that is able to use its profits to soar so high that it skips multiple rounds of funding. And I've got a couple of these in my portfolio. Calm and Fitbot are the two best examples. They're both subscription-based consumer businesses. Interesting, a trend there. And what it basically means is, you don't do these dilutive rounds. So if you skip a 20% dilution round 2 or 3 times, my Lord, you might have twice as much equity in the company. And that's meaningful. And building off profits and being efficient, having low burn culture. That means that those kind of companies, when people come to raise money and they say, oh, well, we want to have 2 board seats, or we want this ratchet, or we want these terms, or we want to buy 25%. You can say, I'm only selling 5%, take it or leave it. I think Notion was the other Pegasus company. They just skipped multiple rounds of funding as well. And so shout out to Sarah Cannon for doing the Notion round. I think they just raised at $1 billion, like 50 million or something, or 2 billion. And they skipped all these, highly dilutive early rounds. And listen, I'm saying that as an early stage investor. And the reason I can say that with confidence is, listen, if I only own 5% of the business or 7% of the business, I really want to own 15, but you don't dilute me 50% in the future rounds, well, I'm kind of in the same place, aren't I? Because the company's worth more. Yeah, I would have liked to own a higher percentage, but it is what it is, right? And actually, it offered the Fitbod team multiple times to invest. They said no to me. We don't need the money, J. Cal. We love you. We don't need the money. And then finally, I got them to accept a couple $1 million at higher and higher valuations, and was able to put a little more money to work. But I'm just happy to be in business with them, and I love an efficient company and a founder. Default dead, pretty obvious. Like, you're not making money. You haven't hit your milestones. You have no more cash, or you're running quickly out of cash. Nobody wants to invest in you. You're kind of going to be default dead. You're what we call in the business a zombie. And so this is why growth is so important. And at some point, you need to know when to wrap it up and just throw in the towel. Concede this match. You see it with chess players. You'll see it in poker. Somebody folds a hand. They had a great hand on the flop, but it got really bad on the river in the turn, and they fold. They could be getting bluffed. They could be a mistake, but whatever. You live to fight another day, play another chess match. Sometimes you take the starters out and you throw in the bench, or you throw in the, developing prospects because you're down 30 and you just want to rest your team, and, you don't play the fourth quarter. It happens. And so, it's important to know where you're at and be candid with yourself. If you listen to This Week in Startups often, you've heard me talk about Odoo's suite of business apps a lot. Well, they're going to give you your first app free forever, and then $1,000 off your implementation pack at odoo.com/twist, odoo.com/twist. And here's why Odoo is so great for startups. Well, their suite of business apps can help you run your entire company from just one platform. They're going to streamline all your workflows by bringing all your information together. This eliminates all the annoying repetitive tasks like entering data across multiple platforms. Plus, if you only need 2 or 3 apps right now, that's okay. Use those 2 or 3 apps to optimize your workflow, and that's all you'll pay for. Odoo is not going to charge you for apps you don't use. Of course they wouldn't do that. So Odoo offers 30 main apps and over 16,000 apps from their open source community. The apps they have, the bookkeeping, sales, CRM, website builders, and more. Again, your first app is free forever, and Odoo is offering $1,000 credit on your first implementation pack. Go to odoo.com/twist for $1,000 off. That's odoo.com/twist.